We're back with the second series of our three-part lending series with Kevin Lucchini of ClearCap Lending. And we are going over unpacking the myths, sharing why not everyone is a traditional mortgage client, and when to know when you're ready for your first investment in real estate. So our second part is all about mortgages. So Kevin, let's start with traditional mortgages. I think when most people say, oh, I don't qualify for a traditional mortgage, or I do qualify for a traditional mortgage, they're talking about the 30-year conventional. So can you tell us what is a 30-year conventional? I know people are throwing in 15-year conventionals, and kind of explain who is best for that.
Sure. So the 30-year conventional, 30-year just refers to the amortization, meaning how long it takes to pay the whole loan off. So there's a 15-year, there's a 10-year, there's a 30-year. It all depends on how quickly you want to pay off your home. The interest rate, obviously, the shorter the term, the lower the interest rate. Those aren't all going to be full doc programs, so there are alt doc and full doc.
Okay, I'm going to interrupt you there. So when you say full doc, can you kind of explain to everybody what you mean by full doc?
Sure. So full doc is 2 years tax returns or W-2s if you're an employee.
Okay.
Pay stubs and bank statements, and that's pretty much everything that we collect. So we need to, and if you're self-employed, we'll just get your full tax return. So you can do full doc as self-employed.
Okay.
But we'll basically verify everything with 2 years of tax returns. They have to be filed. We'll get a record from the IRS, and your tax bills have to be paid.
Okay. So the 30-year and the 15-year conventional are full doc.
The 30-year and the 15-year, because you said the word conventional, yes, are full doc. Conventional loans are all full doc.
Okay.
But not all full doc loans are conventional.
Okay, great. So when buyers are out there and they're getting pre-approved and they're going, and I think most mortgage brokers or mortgage agents are going to say, let's get you a conventional 30-year fixed, because that's just what we hear about most of the time.
Yeah.
So is that for somebody who is a very stable W-2, gets paid once a month or twice a month and has a lot of reserves? Or tell me about who would be the best candidate for a 30-year conventional.
So no, it basically, if you want the fastest answer is you can go to, I believe it's line 21 on your tax returns, AGI, adjusted gross income. So anyone can look at that line, and that's the income that I'm going to use if I take you full doc. So if that income looks good, then then the loan is for you.
And that doesn't mean, and that's regardless of if you're a 1099 or a W-2.
Absolutely. Any of the above. If you're a 1099, you're declaring it, you're writing off your expenses, but the net income is still good, then I can still use it.
On line 21. Okay. So let's talk about then if people have money, but they're not, making as much on that tax return.
Sure. A lot of self-employed people, we have clients like that all the time. Guy makes $500,000 a year on tax returns, it's $60,000 or something like that.
Exactly.
So then at that point, we won't use the tax returns whatsoever. We'll use bank statements, or that's when I use the term alt doc, so alternative documentation to document income. So instead of tax returns, we can use bank statements.
Okay.
Or we can just say, hey, we don't even want to discuss income. Here's how much money this person has.
Okay.
It goes all the way down the spectrum. So if it's a rental property, we can use just the rental income to qualify and not bring anything else into it. And then we can just go to a place where there's nothing. And people call it stated. We don't call it stated, not just because of the stigma, but it's not stated because we don't state anything anymore.
So what's it now called?
Each one has its own name, but it's not stated. Stated is you lie and say you have $30,000 a month.
Okay.
Our programs, you don't put anything. So it's different. And specifically for that reason, we don't use stated programs because you're lying on paper.
Okay.
So obviously we don't want to be using that loan program. So there's no documentation.
Okay. So then let's talk a little bit. A lot of people are throwing around hard money. So when we have clients, and right now the real estate the whole spectrum is just so crazy, right? We have so many offers coming in, and as an agent working and representing buyers, I want to make sure that my offer stands out. So one of the things that we've talked about before is sometimes it makes sense for somebody who would normally get a 30-year conventional, right? They've got a decent interest rate, but they keep getting beat out, and they can only qualify for so much. We would move them over to a hard money loan.
Yes.
And then with that hard money, bam, we get the offer accepted. And yes, it's a little bit higher rate, which I want you to talk about. But once we get in, close escrow, then they have to wait a certain amount of time and they can refinance. And sometimes it's actually cheaper than writing an offer $100,000, $150,000. I mean, there was an article in the LA Times just recently about a property in South Pasadena that went $1 million over asking. So talk a little bit about what is hard money and the advantages and possibly some disadvantages.
Okay, so very basic. Hard money is institutional, smaller institutions that are just lending money, and it's way more informal. There's no underwriting really. They just take anything as long as you put a down payment. What you're gonna end up, so let's talk about the cons of hard money first. The cons of hard money first are you're gonna have to pay origination. There's almost never a way around that.
And is that a certain amount or is that a percentage?
So it's a percentage.
Okay.
Most of the time. It can be a certain amount with some hard money lenders. And again, we go back to how aggressive do you want to be? I think the first loan I did for you guys called me on Thursday. I had loan docs Friday. We funded Monday.
Yes.
That had, I think, 2 points origination on it,
Yep.
and it was in excess of 10% interest rate.
Mm-hmm.
Right, but got the deal
We
done.
needed it, yeah.
Now, had you had called me and said, hey, I need loan docs on Monday, I want to fund by Friday, then the origination falls to 1% and probably
would
under
be.
10, just right under. And again, if you go 2 weeks out, so it depends. You really have to have, what you want to have is you want to have a mortgage broker that just knows these programs.
Absolutely.
And knows what you're trying to do and is communicating with the agent, because exactly like you said, you can end up overbidding for the house, and we could have saved you that in the hard money, and it would have been cheaper. You pay $5,000 in fees to avoid paying $25,000 above asking.
Okay.
So there's that aspect of it. So one of the things you want to be careful with hard money always is there's prepayment penalties with hard money. Much less disclosures going on. You when you're signing the paperwork for a hard money loan, you're oftentimes saying that you're not going to live in the house and it's not consumer purpose, and so that means they can bypass a lot of the rules and laws that protect homeowners on their primary residences.
Okay.
So people need to be careful about that. You don't want to take a hard money loan and say, I'll get out of this in a year, and then go move into that house. You're going to be breaking all kinds of rules. The house could get foreclosed on. You could end up not being able to refinance. It's a whole deal. So that's number one. Prepayment penalty, and make sure they know.
What is there a typical prepayment penalty, like a 3 months, 6 months, 1 year, or does it just vary with each lender?
That is up to your mortgage broker to negotiate. So I don't have
Okay.
like on my hard money, I don't have any prepayment payment penalties.
Okay.
And the reason being is because I send enough business to the lenders where I can say, hey, I'm not going to send it to you if you put a prepayment penalty.
Okay.
I just want to refinance them out, and I'm upfront with the lender. I say,
This is what
15
we're
days,
gonna
I'm
do.
out. And so they'll just charge what they need to make off of it up front. Everything's above board. We all know what we're doing,
Yeah.
and there's no surprises.
Okay.
So it can usually a prepayment penalty shouldn't be on there, especially if you know you're refinancing out.
Mm-hmm.
But if there is, it's typically 6 month or 1 year, and it goes with the maturity of the loan. So if it's a 1 year loan, it's a 1 year prepay. It's usually 1 to 2%.
Okay. Okay.
Yeah.
So what else about hard money should our listeners know?
It's a good resource to have for sure. You want to have it in your toolbox. However, there are some borrowers that I can close the loan faster with conventional than with hard money,
And why is that?
because it's also what my capabilities are limited to what lenders I can go to. If someone comes in, it's like 620, 640 credit score, just kind of mid-grade income, we're just barely on the debt to income passing,
Yep.
And there's things that have to happen, pay off debt, and it's a more complex file.
Mm-hmm.
Now, then let's go alternatively. I have a client right now, I won't use her name, but you guys know who that person is. She has a 5% back end DTI, makes $1 million a year in pay stub income, 800 credit score, money's been in her bank account for 6 months. Well, I'm getting that loan closed in 10 days. It's gonna happen.
Okay.
So basically, it will all depend on who that borrower is. And again, going back to my bag of tricks. Typically what I'll do in that situation is if she puts it in, she can put in an all cash offer or hard money offer.
Yeah.
I'll work both side to side. And then if it so happens that we have to close with the hard money, I'll flip the conventional finance to a delayed purchase.
Okay.
And I can do it just a couple days later, I can close that.
Okay. So we talked about the traditional or the conventional, right? The 30-year versus the 15-year fixed. And then, of course, there's the hard money. So can you talk about a little bit about an FHA and a VA and who would be a good candidate for the FHA VA?
VA, by and
Easy.
far, yeah, easy. If you're a vet, the VA is the best loan for you. There's no loan really better than a VA
Okay.
in terms of rate, fees, everything, all together. So that's simple. The FHA, everyone thinks it stands for first-time homeowner. It's not. It's not first-time homeowner. So FHA is just, it's a conventional loan. It's exactly the same. The only difference is a government entity steps in and tells the investor that's giving the loan, hey, if anything happens to this loan, whatever you don't collect back in the foreclosure, I'll pay you.
Okay.
And for that reason, that's why you pay mortgage insurance. So you're paying that mortgage insurance to the Federal Housing Administration, and they're collecting it for if there's a foreclosure for everyone. Now, where FHA is the best for is low credit. So when you have low credit and you go to conventional without the FHA insurance, what will happen is the lender will jack the rate up because the risk is very high for them. So they want a interest rate commensurate with that.
Okay.
Now, alternatively, on an FHA loan, they don't move the rate up or down much for credit score. Why? Because the risk is built in.
Okay.
So if you have a 600 credit score, for instance, or a 590 credit score,
Yep.
well, your conventional loan rate is going to be 6.5%, but your FHA rate is going to be 4.5%, and then you'll pay 0.85 mortgage insurance.
Okay.
So this is definitely the better way to go.
one. Okay. So I think just to recap, there's definitely a mortgage out there for everybody, whether it's a conventional, an FHA, if you're a veteran, a VA, possibly a hard money. There's definitely a mortgage out there for every single person.
Yeah, our minimum guidelines to find a mortgage for someone is 18 and breathing. There's a mortgage.
Perfect.
So, yeah. If you have those
I think that's a great way to end our podcast today. If you're 18 and breathing, contact us. Kevin and his team at ClearCap Lending can find a mortgage for you.
Yeah.
Awesome. Thanks for your time, Kevin. I appreciate it.
Thank you.
Okay.